Hi everyone. So, welcome to the stream today and welcome back to our IFRS Masterclass as we look at some practice questions, explain some key principles that you must understand to help you position yourself to go into the exam hall and most importantly, pass the examination. Today, we're going to be focusing on a number of accounting standards: IAS 38, intangible assets; IAS 2, inventories; IAS 37, provisions, contingent liabilities, contingent assets, and then also we're going to be sharing our thoughts on IAS 21, effect of changes in exchange rate. So a number of accounting standards we want to get excited about and solve some questions on to help you so you can pass the examination. So welcome. If there are any questions you have, something you want me to share my thought on, don't hesitate, put it in the comment section or the chat. We are going to be going straight up into the discussion, and let me bring up my screen so that we can go real quick. So we are going into financial reporting ICAG November 2025 examination, and we're going to be focusing on the question 2 area to solve some questions there that we must understand relating to these accounting standards. But before I go into the questions, I want to share just some few thoughts with you about the weaknesses that the chief examiner raised concern on relating to the November 2025 financial reporting examination diet, so you have some ideas about what you need to know about generally. So a few things here quickly, then we can get into the questions. First one is that despite the good score in question 1, many candidates struggle with a correct presentation of consolidated financial statement. So presentation of financial statement has been on the lips, if I can put it that way, or in the report of the chief examiner over the previous examination diet. Sometimes it's in question 2. No, question 3, the single entity financial statement. Quite a number of students have problem in presenting the statement of profit or loss, statement of changes in equity, statement of financial position, and also the cash flow statement. And so as you are studying, and then now in the November 2025, the chief examiner's concern was one on the consolidated financial statement, its presentation. And so one thing that I want you to be mindful of is this: if you are writing financial reporting, corporate reporting, note that the financial statements are crucial. And so as you are studying, try to understand the principles, the concepts underlining what you are studying. Make sure you bear in mind the pro forma of the financial statement, because of what use would the workings be if you screw up in the financial statement preparation itself. So it is important that in as much as you are going through understanding the principles, know the pro forma of the financial statement. The statement of profit or loss, how does it look like? The statement of financial position, how does it look like? The statement of cash flow statement, where are we supposed to enter various things? Because all of these will come together to put you in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. The second thing has to do with a considerable number of candidates could not apply knowledge in IAS 37, IAS 38, and IAS 21 to answer the question in the question 2. And the question 2 is on the standards. I mean, there is no way you can walk into a financial reporting examination without understanding of IAS 37, IAS 38, IAS 21. These are, one of the basic standards or some of the basic standards that you're supposed to know about. But quite a number of students struggle in answering questions with this area or in this area in the question 2. So again, be mindful of the standards, be mindful of the principles, be mindful of the concept to put you in the position to pass the examination. Then third, question 3 is the preparation of profit or loss and OCI, right? Poses the greatest challenge for most candidates. Some candidates did not appear to know the format and the content of these 3 financial statements, as they failed to present their answers properly. So that was what I was mentioning earlier about the presentation of the financial statement, the pro forma. And so be mindful of the pro forma of the financial statement, because again, all that adds together to put us in the position to go into the exam or write the exam with confidence and pass the examination. And then question 4 proved challenging to candidates. Now, question 4 is about evaluation of financial statements. I mean, again, you cannot go to the corporate financial reporting examination, by extension, corporate reporting examination, without a deeper understanding of evaluation of financial statement. And so these are some of the concerns. Many candidates fail to apply the relevant IFRSs correctly, highlighting the need for a stronger grasp of the standards. Because the accounting standards act as always the pillars that holds the syllabus. Question 1, consolidation, accounting standards. Question 2, the accounting standards. Question 3, the accounting standards. Question 4, the accounting standards. Even question 5, the written aspect, we could have accounting standards coming in. And so it is important you understand these very well to help you put yourself in the position to go into the exam or write the exam with confidence, and most importantly, pass the examination. So these are just some few comments from the examiner, and we've mentioned this over and over again. I just wanted to highlight on them so you understand the impulse or the impact of the various things that we are discussing and the things that you have to pay attention to as you are going into the examination. All right, so let's come to the work of the day. Question number 2. All right, we are looking at question number 2, ICAG Financial Reporting, November 2025, past paper. We're going to be exhausting all of the questions in question 2, highlighting some of the fundamental principles that we must understand when it comes to dealing with these areas, generally at the end of the day. So let's start with question 2A. Now, if you are a follower of my work, one of the things that we have mentioned or talked about quite a number of times is the verbs that a chief examiner is going to be using in the exam hall. So the examiner can say calculate, describe, demonstrate, explain. You must know the structuring of the answer to the question based on the active verb that the examiner used in the question. So for instance, I want you to pay attention carefully as we go through these questions and then try to crystallize some of the things that we are talking about here. So look at the A aspect of the question. It says, for 4 marks, the examiner says, explain the financial reporting treatment of the above transaction in the books of Salonlier, I don't know what it's that, for the year ended 30th June 2025. All right, so A, Salonlier Limited. Do they have limited? Just Salonlier, okay. Now, active verb here is explain. So it means that you need to speak English, right? You need to write something down because it's a 4 marks question. Again, it depends on the marking scheme that the chief examiner is trying to use for the given examination date. However, sometimes the explanation can be 1 out of the 4 marks. Sometimes it could be 3 out of the 4 marks, depending on the structure of the questions. Sometimes in the question, we don't have a lot of calculations there. So the whole 4 marks question will be an explanatory thing that you are supposed to do. And so if you're not able to structure yourself very well, that means the whole marks, you're likely to walk away with 0.5, probably for some entry that you're able to make at the end of the day. So let's look at this. So it says explain. Explain. So I'm going to do a freestyle, right, for you to understand how the explain thing will look like briefly, because it is important you understand the structuring of what the examiner expects you to do in order to optimize your chances of passing the examination. So Salonlier is a Ghana-based manufacturer and retailer of ice cream and frozen dairy products. The company had a license valued at 4.4 million Ghana cedis in its draft statement of financial position at 30th June 2025. Stay with me carefully. The company had a license. Immediately I hear the word license, it means we are dealing with intangible assets. And so that is IAS 38, intangible assets. And for license, usually they are intangible assets with definite economic useful life. And so we must amortize the license over the economic useful life of the license on the overall. So IAS 38 is coming to town here. Now, the figure given to us is 4 million, and that is the figure at the reporting date, 30th June 2025. Stay with me carefully, Because if you pay attention to the requirements of the question, we are also supposed to explain how this will be treated at 30th June 2025. So the 30th June 2025 carrying amount here is at the end of the year. So they've already calculated the amortization for the year in respect of that. And so this is the balancing figure at the date or at the reporting date. Okay, so we know we're going to apply IAS 38 here to answer the question. Let's proceed. The license was purchased on 1st July 2022 for 10 million Ghana cedis and was valid for 5 years. All right. Amortization has been charged for each of the full year to 30th June 2025 through cost of sales. The examiner didn't have to tell us that, right? That particular sentence there, he didn't have to tell us that, but he was gracious to do it. Okay, because once you are given the carrying amount at the end of the year, you should know that amortization has been charged already. If not, we wouldn't have had the carrying amount at the end of the year on the overall. A clause in the contract allowed the licensor to withdraw the license with no compensation if certain financial health measures are not maintained to protect its own brand. Okay. So that's the first paragraph. Nothing to report here apart from the fact that two things. We're going to apply IAS 38, intangible assets. 2, they've already charged the amortization for the year, so we are not going to amortize anything. The third thing here is the condition or the clause attached to the license that the licensor can withdraw if the entity doesn't maintain a certain financial health. So let's come to the final paragraph because possibly that will open us up to something else. Despite the refinancing, you ask yourself, despite the refinancing, it looks like, sometimes you sit down and look at some of the questions and you're like, some things are being cut in the question somewhere and then they are building the story up as we go, but we move. Solon Air failed these measures in the first half of 2025, and the licensor notified Solon Air in May 2025 that it would indeed withdraw the license effective 1st July 2025. Stay with me. The year ended is June. So January, February, March, April, May, June. So before the year end, they got a notification from the licensor that we're going to withdraw. Okay. For tax purposes, allowances for the cost of the license are allowed on a straight line basis over the 5-year period. The tax allowances for the cost of the license are unaffected by the withdrawal of the license. We are done. And so for 4 marks, the examiner is asking students, explain the financial reporting treatment of the above transaction in the books of Solon Air for the year ended 30th June 2025. And so just a freestyle. Let me explain, then we write some English down, then we move. Now, since the licensor is going to withdraw the license, what it means is that at the year end, 30th June 2025, that 4 million carrying amount of the license must be written off. That's all, because we need to de-recognize it. Because now the entity will not hold that license again, so it must be written off. However, we are told that the tax effect of that still remains in the book. So going into the next subsequent year, 30th June 2026, the entity will still earn some tax benefit from it. But that would have no consequences for the year ended under review. But for further understanding, that is why this will be necessary. So the license must be accounted for in accordance with IAS 38 intangible assets as appropriately reported, because they've done the right thing by the entity as at 30th June 20, 20 what? 2025. However, due to the notice of license withdrawal by the licensor in May 2025, Solan Le will no longer operate in the name of the license and hence must be derecognized in the financial statement. Sounds good? And hence must be derecognized in the financial statement. And so if we want to pass a simple journal entry, we say we debit profit or loss. Now, we are told that the amortization of the license had been charged through cost of sales. So if we are debiting profit or loss, we can write it off against cost of sales as well for that same year ended. Okay? That's 4 million. Then you credit the license in the name of intangible assets, 4 million. What it means is that in the statement of financial position for the year ended 30th June 2025, we wouldn't have this 4 million under intangible assets for the entity. This is the answer to the question, and that is what you must understand when we talk about this question here. Again, my goal here for you is two things. One, understanding the principle to apply to solve the question. Right? That is important. Understanding the principle to apply to solve the question, but also this way you are supposed to write out your answers based on the way the examiner is asking the question. And that is very important because if you miss the way the examiner is asking the question, then you're going to have a lot of problems going into the future. Any questions about this? Let me know. You can put your questions in the chat for me or in the comment section for me. I see some of you guys joining. You are welcome. We are doing the IFRS Masterclass, and we are looking at some questions in the financial report in November 2025, focusing on question 2. So make sure you share the video. Let's reach as many students as possible watching the stream and help a lot of students to put themselves in the position to pass the examination. So that is the A aspect of the question. Very sweet, simple, straight to the point. Let's look at the second one, B. Let's look at the B aspect of the question. B says, also for 4 marks, all right? Remember, this is a 20 marks area, right, as always. So sometimes the examiner would like to have 4 times 5. So there are 5 key areas that the examiner will want to, pick students' brain on. Required. In accordance with IAS 2 inventories, recommend the appropriate accounting treatment of the above transaction. Again, the word here is recommend. To recommend means you got to speak some English. So again, there will be a little write-up in the build-up here in the B aspect of the question. Because you can't recommend and just do calculation and walk away. You have to speak some English. You have to give an explanation to what you are doing. So I want you to pay attention to that. The reason I'm emphasizing on this is because Many students leave marks on the table because of applying or not answering the question in the manner they are supposed to answer. Because anytime people see questions, oh, calculation, then they go away. They do the calculation and walk away. But if the spirit of the question is describe, explain, recommend, and you ignore that portion of the description, explanation, or recommendation, then you are likely to lose some marks at the end of the day. So let's see what we have here. Joe Logbori is a food. Joe Logbori. What kind of names are these guys using these days? Joe Logbori. Logbori. It's a food and beverage company with a strong presence in Africa. Known for its popular brand like Cowbell Milk and Onga Seasoning. For the year ended 30th June 2025, the inventory shown in the company's draft statement of financial position was at a cost of 54.2 million. The inventory count revealed 2.2 million at cost for out of date inventories that no longer be sold, that could no longer be sold and will be disposed of for no income. An additional cost of 40,000 Ghana cedis will be incurred to dispose of these inventories. Stay with me. Stay with me. And so what do we do here? Again, this is inventories. You know that we say inventories must be carried at lower of cost and net realizable value, right? And so at the reporting date, the inventory is 54.2 million. However, we are told that 2.2, of these are out of stock and they cannot sell them. And so let's look at the out of date inventory, okay? So cost of out of date inventory. I'm not going to write English here, okay? Now you know the flow, right? So I'm not going to write English here in that case. Or what do you think? You let me do some freestyle for you. Some of you, you're like, oh, should I write the English? Oh, should I write the English? You let me do some freestyle for you quickly. Then we go. As per the guidelines, in IAS 2 inventories, IAS 2 inventories must be carried at lower of cost and net realizable value. Although the closing inventory is 54.2 million Ghana cedis. $54.2 million Ghana cedis. 2.2 million are outdated or out of date and will be disposed of at no income. This means the net realizable value of these inventories is 0. Okay. As such, the inventory at the reporting date will be written down by 2.2 million. Sounds good? 2.2 million. The 40,000 costs that will be incurred to dispose of, that will be recognized when they eventually incur the cost. Okay, so the disposal cost of 40,000 Ghana cedis will be recognized when incurred. All right. So, journal entry, if we want to, we will debit. We are writing off inventories. Usually, inventories will be written off in profit or loss, in cost of sales. Okay. So, that could be in cost of sales. The reason the classification is important is because, you see, sometimes you know something is supposed to be in P&L. But which portion or like which segment of the P&L is it supposed to be? Which part of the P&L? Are you supposed to bring it in cost of sales in arriving at gross profit? Or you're supposed to bring it in operating expenses in arriving at profit before interest and tax? Because if you miss that, then it means that your cost of sales figure is going to be wrong. Your gross profit figure is going to be wrong at the end of the day, and you're going to lose significant amount of ticks. And then if it comes to evaluation of financial statement, where you are making those adjustments to be able to calculate some ratios, it means your adjustment will be wrong, and then the ratios you are going to calculate will also be wrong. So that's why you have to be careful here. It's not just about, I'm able to apply the principles. It's also knowing how to answer the questions based on the context of the question. Then if you're going to present something in the financial statement, also knowing where is it going to be exactly in the financial statement so you don't screw it up. Very important here, right? Very important. So we debit profit or loss cost of sales usually for the 2.2 milli. Then we credit inventory because we are writing down inventory, which will be under current assets on the face of the statement of financial position, 2.2 milli. So that is the answer to the question here. B for 4 marks, IAS 2. Very sweet, simple, straight to the point here. Any questions? Everybody good? That is the answer to the question, and we are done here as well. Right? Very sweet, simple, straight to the point. Let's go to the C aspect of the question here as well. Now, I want you to pay attention to the C aspect of this question. Quite an interesting one. It is for 3 marks. What adjustment should be recorded at 31st March 2025 to ensure the provision is correctly accounted for? So here, the examiner is just asking you what adjustment? What adjustment? So specifically, so we wouldn't need to really write a lot of English here. We could go straight up and then be specific and boom, 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 and go away. But let's see. But you got to be careful here because it says to ensure the provision is correctly accounted for. So the focus here is on the provision. Got to be careful on the provision. Now, immediately I hear provision, IAS 37 is coming to town, as stated in the preamble of the question. IAS 37, provisions, contingent liabilities, and contingent assets sets out the principles for recognizing and measuring provisions. IAS 37 requires that in cases where the time value of money is material, the provision be measured at present value at the reporting date. Gontor PLC. So let's go to Gontor PLC. Gontor PLC has an obligation, because remember, because we can make provision for something, a liability, there must be a present obligation. And that present obligation can be either constructive or legal. So there has an obligation to restore a site following the completion of mining works currently underway. The estimated cost of these works is 30 million or 30.225 million Ghana cedis, and the works are expected to be completed on 1st April 2034. The present value of the restoration cost was recorded at 14 million on 1st April 2024. I need you to pay attention here. So we've been given the future value, and then we've been given the present value. So we wouldn't have to think about any discounting again. They have already done the discounting. So the present value at the beginning of the year, because if the year ends on 31st March 2025, then it started on 1st April 2024. So 1st April 2024 is at the beginning of the year. And so they have discounted it into present value at 14 million Ghana cedi. Okay. The company's cost of capital is 8%. What is the requirements of the question? What adjustment should be recorded at 31st March 2025 to ensure the provision is correctly accounted for? We unwind. Since we have the present value, we unwind by calculating the finance cost. Okay? Unwinding or finance cost. So that is going to be the 14 milli Ghana cedi multiplied by 8%. And it's a full year, because 1st April 2024, 31st March 2025 is a full year. So we bring that in, 8% on 14 million, 0.08 by 14, and that is 1.12 million Ghana cedi. So what's the journal entry on this? Pretty simple. We're going to debit profit or loss. Normally may go to finance cost. 1.12 milli. And then you credit the provisions. On the face of the statement of financial position, 1.12 million. That's the idea. What it means is that at the reporting date, the carrying amount of the provision. So at 31st March 2025, the carrying amount of the provision is the 14 million plus the unwinding of 1.12 million. So that's going to be 15.12 million. Okay. So at 31st March 2025, the carrying amount of the provision is this. Under non-current liability. Okay, so this will go under non-current liabilities on the face of the statement of financial position. So this is the answer to the question as well when it comes to the issue in respect of IAS 37. So what adjustments should be recorded at 31st March 2025 to ensure the provision is correctly accounted for? To ensure the provision is correctly accounted for. That's it. Very sweet, simple, straight to the point. That's all there. So if you follow the discussions very well so far, none of this question is difficult. Very easy peasy questions, right? Look at the Salome question. Like, it's very easy. I mean, you have a license, they are redrawing the license. It means you don't have the license again. So what do? You write off the license from your books. That's not rocket science, right? Then Joe Lobori, the issue in respect of the inventory. You have inventory. Some are damaged or expired, and you're going to dispose them off for no income. Okay. That means your net realizable value is zero. So you won't get anything from it. So you got to subtract that from the carrying amount of the inventory at the end of the day. Then Gontor PLC, IAS 37, unwinding of the finance cost. Not a rocket science. You've been given the present value already, so you work with that. So what am I driving at? This is what I'm driving at. What I'm trying to say is that the ICA examination is not difficult. The questions are not difficult. If you understand your principles and, most importantly, how you are supposed to present your answers at the end of the day, you're going to be good. You will definitely be good if you have a deeper understanding of what you're doing very well at the end of the day. All right? Let's get a fourth one here. What do we have? For D, 6 marks. It is, in each of the scenarios, I to III above, outline the appropriate accounting treatment for the year ended 31st July 2025. Outline. So the active verb here is outline. When you are told to outline something, it means you are going to be what? Making an explanation, writing an explanatory note. That's outline. Explaining something. So it's not about doing calculation and walking away. No. Explain. So the active verb outline, show us, demonstrate, write it out. Okay, so let's see what we got here. Tenu Limited. Tenu Entertainment. So D. Tenu Entertainment. Let's see. It's a Ghanaian record label founded in 2006 to provide services in artist management, music production, film, and television production, event management, and brand partnership. It has entered into the following transactions during the year ended 31st July 2025. During the year ended 31st July 2025. Let's see. On 1st August 2024, remember, if the year ended is 31st July 2025, July, August. So the year starts on 1st August 2024. I keep on emphasizing on this because, again, if you miss the year ended, you miss the period, you are walking away with Zokbo. Zero. So that's why it's important for you to understand. Am I at the beginning of the year? Am I during the year? Where exactly am I at the end of the day? Let's see. Tanu acquired the exclusive Ghanaian distribution rights for a unique home entertainment digital set-top box. Listen carefully. Distribution right. That's an intangible asset. So IAS 38 is coming to town. The cost of the right to Tanu was 2.1 million and the term of the deal was 3 years. Okay. So acquisition of distribution right. Okay. For 3 years. As per IAS 38, I'm not going to write lengthy English here because by now you are familiar with the flow, right? So I'm not going to write a lot of English here. I'm going to keep it sweet, simple, straight to the point here. So for the distribution rights, as per IAS 37, the cost 2.1 million Ghana cedis will be amortized over what? The 3 years. Okay? And since we have done the first year, we will do the first calculation and then do the rest. So as per IAS 38, intangible assets, the cost of how much we got? 2.1 million must be amortized over the term of the deal, which is 3 years. And so for the year ended, so for the year ended 31st July 2025, an amount of 2.1 divided by 3 is Ebaze. 2.1 milli over 3 years. So 2.1 divided by 3. 2.1 divided by 3, 0.7. So an amount of 0.7 million shall be recognized in the financial statement. Okay, in the financial statement. And so if I want to pass a journal entry, it'll look like this. The journal entry will be to debit the profit or loss with the 0.7 milli. Now, where exactly in profit or loss should this go? It's an entertainment company, and so this right of distribution will be part of their core things they do. So it will be in cost of sales for the most part. Okay, this could be in cost of sales for the most part because it's an entertainment company, and then the right forms part of their core activities. Okay, so it'll be cost of sales usually. Yeah. Yeah, sometimes, the marking scheme could give a leeway, and say, oh, if students present some things in another area or another segment of the syllabus, it should be allowed, right? But knowing and doing the right thing based on the type of organization and the cost or the, how do we call it? The entity in question and then the transaction in place will be important. Okay, so distribution right, which is an intangible asset. Okay, IA, not artificial intelligence or something like that.